mic button you click. Let's start. Let's shift to the new chapter. Check voice is audible, all of you. Voice is audible. We'll move to the portfolio management. We'll move to the portfolio management. Now, I'll just quickly do a recap. In fact, entire chapter what we'll be doing. Let me slightly do a recap with you. The portfolio, because formulas I'll discuss with you. Maybe some derivations I'll discuss with you, which becomes easier for you to remember the formulas and how the application. This entire chapter is about the formulas only. One or two places we have seen few things have came off. Maybe one question which came in 2008, I think 2007, and repeated itself maybe 1 year back or 1.5 years back. Something different type of scenario I'll discuss with you. Controversies would be there. Any controversy, entire chapter, let me be very frank with you. Any controversy which would be there, if it is maybe an opinion, so we'll go with the opinion of the institute only. If there is some problem and that problem they have repeated 3, 4, 5, 7 times, they are doing it. So maybe I'll ask you, you have to learn that way. But I'll tell you what the problem is and how it can be modified. I don't know whether these kind of problems I would have taken or not. The entire chapter portfolio when we speak about is basically risk and return. The name of the chapter should have been a risk and return. So entire chapter, instead of saying a portfolio management, we could have said chapter as risk and return. We'll divide our entire chapter into two parts. Risk calculation majorly he does at a standard deviation level. It could be at a variance level also, could be done. So standard deviation square would be a variance level. Initially we learn about calculation of the standard deviation of a single asset, and then we learn about the calculation of the multiple assets. And then standard deviation has a problem, because when you are looking at that risk or applying a Markowitz formula or some formulas, you have to find correlations. So for 2 it's possible, 3 could be a possibility. As you exceeding, there is a problem which comes out. So beta takes care of it. We move to the beta and then some characteristic lines. Basically this entire chapter could be framed approximately around 3 lines. But since in your exam they'll ask you the formulas, we'll talk about the formulas. Few questions which require slight of importance I'll anyhow discuss with you. But keep in mind, no matter what happens, this chapter is about entire risk and return only. Around 2 things you'll move forward. Return is a weighted average return. If I have a couple of assets, the risk is not a weighted average. That's one point which from the beginning itself will keep it. Risk is never an average. This depends on what kind of a correlation is between the two numbers. For example, if you invest in 2 companies, if they're highly correlated, risk would be higher. If they're low correlated, risk would be reduced. Their correlation depends. Return is always a weighted average. So portfolio manager tries to look for such kind of 2 securities whose return is maximized and the relationship is weak. That means they try to hedge, you can say, or kind of nullify the effect of the risk parameter. Now standard deviation, the question itself will learn. So I'm not putting a stress on the standard deviation. Standard deviation is basically deviation from mean. If you want, you can quickly cut some data point. I can, maybe I would not have covered in the slides. When we speak about this term here, risk of a single asset, the standard deviation formula you know, just quickly discuss from here. You will not have that slide, don't worry. I'll just discuss from here. It's a deviation from the mean, because in MCQs he can ask you deviation from the mean. Higher the deviation, higher would be the risk. Lower the deviation, lower the risk. It's an absolute measure of risk. When we speak about absolute measure of risk, that means when the fluctuation comes, it is not percentage wise. If the data in percentage, answer would come in percentage. If the data is in rupees, answer would come in rupees. And this could even be part of your capital budgeting, because in that also risk return, some risk parameters are used at different levels, because risk and uncertainty, one of the topics is there. So it's an absolute measure of a risk. It's a measure of a total risk, which captures systematic and unsystematic risk both. When you take a historical data or a forecasted data, when we speak out, historical is to calculate the mean. Whether this formula is right or not, we are not debating anything on that. Maybe practical life, when you go, there could be some difference. You have n minus 1 and so on. So assume this is the correct formula because your institute uses, that's fine. Otherwise, there is the CPT world, you would have done something called n minus 1, or in practical life there could be a possibility. So deviation you calculate, I put it at dx, you can put x minus x bar, and deviation square x minus x bar the whole square. I just put it at d is deviation to the power 2 into the x. The mean data, how would we know, sir? Mean data is there, he'll give the probability. If he gives a probability, the data would be about the probable. The probability would be given. The sum of the probability would always be 1. Some benchmarks with the examples I'll tell you to keep in mind when you solve the question. And then we find out the data. That's 2017, 18, 10, 14. And you calculate the sum of the deviation should always be 0. So I would request you, whenever you move forward in any question, because using this you'll find standard deviation, using this you might find covariance, correlation, beta, etc., characteristic line, and n number of things we can work out. If generally, if you make a mistake, you'll make a mistake at this level only. The sum of the deviation should be 0, and that is why you do the squaring part of it. There could be different reasons of talking negative number, positive number, but do not move forward till the time you get this deviation sum 0, x minus x bar. If maximum time, problem would be here only. The moment you have a problem here, the entire data will go for a toss, because the entire things will be linked. It could be a standard deviation, it could be based the characteristic line, it could be beta, it could be covariance, anything which moves from here. Then we talk about this, I'll talk about in the sheet only. Coefficient of variation, in fact, is one. Variance is basically standard deviation square. Coefficient of variation is standard deviation by expected return. And then I have something called I've taken some data points here. I'll just quickly discuss with you, although you would be doing in the question when we do in the practical sum. Let's suppose there are two cases, A and B. A gives a return of 10, B gives a return of 10, standard deviation 4 and 5. We can easily prima facie make out from it. Return is same, risk is lower for whom? A. So select A part. Second is A and B, expected return 10 and 15, standard deviation 5 and 5. B is efficient since it gives what? Higher return, same level of risk. Third data point what we have from this chapter point of view, slightly I'll do it. The data is A and B 15, 20, 5 and 8. Now if nothing is said, you will not calculate COB or you will not decide any one of them. Risk return increases, risk has to increase. Risk and return are not proportionate. So yesterday when we were doing currency derivatives in the previous class, we used a term called risk averse. There could be a risk lover and risk averse. So basically we say both are efficient. The efficiency wise, if I use a theory, then we say both are efficient because it gives what? Similar type of a it gives a return 15 to 20 and it shifts from what? 5 to 8. So the proportionately it will not move. If the question says select any one of them, if by chance it says select any one of them, then in that scenario what you have to do is you have to apply a COB. Although you can apply some other concept, return by risk also, but COB is the maximum time used concept in which you'll apply this part here. So that's one part here. After that I would have taken a small example to calculate. Let me go to now question and then I'll discuss with you something directly. Let me look at, read question number 37. I'll make my rule, only first part read it please, and then I'll discuss some theory and then we'll move forward. So I'll start with the question only. This question would have come approximately 5 times or so. A common mistake we make is exactly same what I was talking to you. Let me show you one example I have taken, I think. Let me discuss from there the sheet which you will have. Exactly same thing we have it here. Following is the data available for 6 securities A, B, C, D, E, F. Return is given 14, 18, 20, 20, 35, 28 and standard deviation is given. Risk is given. You cannot directly apply COV. Please remember, you cannot directly apply COV. If this kind of a question comes, what we'll do is look at the similar risk or return companies. For example, I have to find efficient securities. We have to find the efficient securities, and when I have to find the efficient securities, we compare A and B. I compare A and B because their risk is same, 14 and 18. So we say B is efficient. B is efficient since it gives higher return at same level of risk. Then I look at C and D because they have 20-20 common. The return is common. In this case, the D is preferable. We call it as efficient. I am not saying best. The word is not used best. It's efficient. D is efficient because it gives what? Same return at what? Lower risk. And then we have E and F. E and F comparing, if you look at, the return is decreasing but risk is what? Increasing. In this case, we'll select what? We'll select E. E is efficient. And when we draw this kind of a diagrammatical presentation, which is not required with the doodle task, basically efficient securities will fall on this frontier, and any points which falls below this are called inefficient in nature. Now going back to that same again, what we were discussing in this part, if you look at the structure which we are looking, it gives you the 6 securities. Now in this case, when he says which of the 3 securities will be selected, when he uses the word which of the 3 securities will be selected, you will be comparing. You can either look at same risk securities or return securities. I look at A, B and E because 8, 8 and 8, and then risk is 4, 5 and 6, which comparing A, B and F. So B I'll cut out, F I'll cut out. Then I have A and D. Then I have A and D because risk return is same. D gets cut out. Now the way of comparison, easiest way to do comparison is risk increases from 4 to 5, return increases from 8 to 9. For postnet we do not talk. Risk increasing, return increasing, both are efficient. Risk increasing from 5 to 12, huge risk is increasing, and return is increasing 9 to 12. It's okay. These are still efficient. So 3 securities which would be selected would be A, C and E. A, C and E. 3 securities. You can call them as the efficient securities. In case he would have said select the best one out and so, which he generally do not ask, then I could have used COB, which I have given this slide also answer to you. Maybe you can go back home and refer it out if you want. So he says which of the 3 securities will be selected. We have A, C and E. And then for second part, let me discuss with you a formula of portfolio. In fact, let's look at the first part answer. I'll show you. Want to copy down the first part answer. Slide could be there. Number 20, 30. Way of writing answer. Slide I might not have given it. Briefly, you can look at. This chapter is formula-wise lengthy chapter. You can see a formula-wise lengthy or a pain. Call it as. Basically, the way of writing answer would be when we write the answer in the exam, we say first data is we compare ABF A is efficient since it gives same return at lower risk. So automatically B and F gets cancelled out, comparing A and B, and then you said be comparing what? A and you compare A and D. A is efficient since it gives high return at a same level of risk. So D also gets cut out. In this case, only 3 securities are left. I think A is left, C is left, and that's first part answer. How is B efficient? You never compare. I'm saying in efficiency theory, you never compare the proportion. That only comes at select the best one out. We do not never compare proportionate return. You can imagine if you would have played these sports with two best batsmen in the same state, but if one has to represent the state, let's say school competition happens, the two best players in the school, two best players are in the school itself, but school can represent only one because everyone has to participate. If you by chance happen to have played sports, you'll come to know that how exactly it happens. So if let's suppose there are 3 students in the class, they're extraordinarily good and they can secure 1, 2, 3 rank in the state level, but one school cannot represent 3. It has to represent only 1. Exactly same thing applies in this part here. So you have to cut out the efficient ones. When you draw this on the line chart, automatically they'll be inefficient because they'll fall below that efficient frontier. So second part, when we go on risk of a portfolio, the risk of a portfolio consisting of 2 securities. Return of a portfolio would be standard deviation, is the normal weighted average. Risk of portfolio would be A square weight A square, B square weight B square, 2AB RAB. A stands for standard deviation A. This correlation coefficient is important. Higher the correlation, risk would be higher. Lower the correlation, risk would be lower. The weight of A, you can remember it by A square, B square, and 2AB in RAB. Standard deviation of B, weight of B, and correlation coefficient. I've taken example here to understand security A and B, 15%, 18%, 5, 9, 0.4, 0.6. Calculate the return and standard deviation of portfolio if RAB is 0.2. Return of a portfolio is return of A, weight of A, plus return of B into weight of B. Standard deviation, when you apply the formula, my expectation would be, maybe formulas do not check, or if you remember the formula fine enough, just do the calculations part so that you're comfortable when you revise at home. It's A square weight A square, the B square into weight B square, 2AB into RAB, you should get 6.12. Now with this I would have taken, now this has been taken, one part I want to do along with this. If you by chance do one thing now, instead of RAB, when you go back home, make it RAB as 0.5 and rest remain the same. Rest keep the same. Return of a portfolio will still come 16.8. Return of portfolio is weighted average. Risk of a portfolio is not a weighted average. It depends on the R. Risk would increase. So we say risk of a portfolio depends on the correlation coefficient. Higher the correlation, risk would be higher. The portfolio manager wants to find out such 2 securities in which risk can get cut out. So that's the formula which talks about. So return would be weighted average. Risk is not a weighted average except at one place. In the next slide I would have taken, if RAB is +1, it's called perfect positive correlation, which is the rarest circumstance. Perfect positive correlation is the rarest circumstance you have. In that case, you will get standard deviation of portfolio is A plus B. Standard deviation of portfolio is standard deviation of A weight A plus standard deviation of B weight B. If RAB is -1, we call it as perfect negative correlation. The risk gets cut out. The risk cuts out here. So you remember the formula A square B square plus 2AB. If R is given, multiply by R. If R is the +1, it's the range of the correlation is -1 to +1. The range will be from -1 to +1, and in -1, when we have a range +1, 0. In this case, you will not even have the securities which will be negatively correlated highly, but there could be some correlation which could be or cut out, or the portfolio manager will try to find out on this side which comes, because if you move towards the positive side, the risk is increasing, so they'll try to move to the lower side. So let's suppose in the MCQ he asks what type of a combination portfolio manager will select, whose correlation coefficient is +1, 0, -1, or no correlation. So basically the risk will get cut out at what? -1. I'm just assuming these things will become important for you because he'll ask you the concept part here. And if I would have shown that something on the line chart, we generally do in the classes when we look at, we try to draw some line and try to put some combination of the x and y that we show. If they're falling apart from that line, then that means the correlation is weak. If they're closer, correlation is higher. So diagrammatical presentation, examination pattern he never asked, so I'm not putting a stress here. Only objective is you should know that if R is positive, automatically this will come higher. Way of remembering is a square b square plus 2ab. Now the question number 37 which we were doing, in that we have already selected 3 securities, and 3 securities which we have selected are nothing but the 3 securities what we have selected are, I go back, are ABN, ACN, ACNE. Assuming perfect causative correlation, analyze whether it is preferable to invest 75% in A, 25 in C, or invest 100 in E. Now what he wants from us is, wants a combination of A plus C or E. If I try to put a summary here, return and standard deviation, A plus C return I don't know, E return I know is 9%, and this is 5. Return of a portfolio which consists of A plus C, can multiply return of A is 8 into weight he wants to put is 75. B is, no, C is how much? 12. 12 into 0.5. How much? 9, complete 9. 9. And then since it's a perfect positive correlation, so I can put a shortcut formula. Standard deviation of a portfolio which has A plus C is weighted average. Standard deviation of A, weight of A, weight of C. We have come as 4 into 0.75 plus what? 12 into 5. Now we can take a call which one is better off. Since return is same, the E is better off. This question is the one of the most common repeated question. The only problem I'm saying is don't directly calculate this. Please cut out the securities which have a common link, and then you can get the second part. That was basically standard deviation of a portfolio. Now standard deviation of a portfolio consisting of 3 securities, I'll just do a formula. The formula, because one of the lengthy questions might be using it, so I'll just use formula. I would have question generally I have not taken. Prima facie I have not taken, but if required I can add. So I'll just show you the formula. Application will should come at some place. So if it comes at some place, if it does not come, then I'll try to show you something between. Next part of the slide here. Question number 12 is not with you. I'll just show you this formula which comes out here. Say standard deviation of a portfolio consisting of 3 securities, A square, B square, C square plus 2AB into RAB, 2AC into RAC plus 2R. This is the easiest way to remember. Generally a student remembers this formula, but in exam the data which he gives in such a way that the application of this formula comes handy. Application is A square, B square, C square plus 2 covariance AB. Now how that comes is, if anyone recalls back, I'll just write down a R formula for you. RAB formula, correlation formula is, correlation is basically shows relationship between two numbers. So we say in variance is basically, if I put a variance, let's suppose if I put a variance is standard deviation A into what? Standard deviation A. Relationship with itself is 1. If I want to try to find a relationship between two numbers, we use a term called covariance. So the formula becomes as covariance covariance A and B divide by, if I do variance AB, it's a standard deviation A, divide by, I do the standard deviation A into standard deviation B, that comes the RAB formula. And if I put the covariance formula from here, covariance would be equal to RAB into standard deviation A, that comes out the formula. Now what has been done is, highlighting in yellow, it's A RAB gets substituted with this. Generally you will find in the books the formula, they'll be using this as the formula, and they substitute A and this covariance, E covariance. RAB is basically covariance AB by standard deviation AB, and covariance would be RAB standard deviation A standard deviation B, which comes. That's the formula we'll be using, and I think some of the using that formula. And covariance formula, if you want to put, might be requiring at some, and put down a covariance formula. This covariance from here, RAB. Now if I try to calculate covariance between the two numbers, covariance is nothing but I want to check a relationship. Actually covariance tells you that there is a positive relationship between two numbers or a negative relationship between two numbers, but the covariance does not tell you about the magnitude of that relationship. So we have a R tells you the strength of the relationship. R captures -1, 0.5, 0, 0.25, 0.75, 0.9, that captures the strength. Covariance also tells you whether we have a positive or a negative relationship. The R also tells you you have a positive negative relationship, but R captures the strength of that relationship which comes out. Now if you try to look at the covariance, let's suppose I would have asked you calculate the variance. You would calculate variance is what? You will calculate deviation of A. Let's suppose A is a security. You calculate, how do you calculate? Let's suppose A data is there. If A data is there, you calculate A minus A bar, I call it as deviation of A, and then you do what? D square A, and then the variance when you calculate, it will be D square A divided by N, and if you calculate the standard deviation, you do under root. Now instead of the variance, I am asking covariance. So look at how you will calculate the covariance. Exactly using the same above logic of the formula, we say if one security is A, we will calculate deviation of A. Another security is what? B. We will calculate deviation of B. If I need to calculate a covariance, the covariance would be dA into dB. dA into dB, and when you multiply d square A, you divide by N, you get the variance. If you have a covariance, if I write here covariance formula between two numbers A and B, we'll say summation of historical number would be dA into dB divided by N, and if there is a probability, then you will have P into what? dA into dB. And easiest way to remember is, if you substitute B with A, it will become what? Variance. So covariance will capture, it's a negative relationship. Actually someone can ask you in the interview by chance that if covariance captures a relationship negative positive, then what is the use of R? R captures the strength of that relationship. It's when we say 0.9, for example, I might be using in some data, definitely covariance should come in one of the data points. I'll show you there. When I calculate, it comes -400. I know relationship is negative, but what kind of a relationship is that? We cannot make out from the covariance. R captures the strength of that relationship. 0.9, -0.7, -0.2, -0.1. So that tells the negativity plus the strength of that relationship. This is my covariance formula which comes. So I'm not taken the basic formulas, just that could be with the examples I'll be using it. Covariance is if division of A, B divided by N. It's a P into AB, and using this we calculate, once we calculate covariance, actually when I use a word, generally when we do in the classes, spend some time comparing, when we use a word called variance, variance captures relationship between A and A. The moment I do the word covariance, it is basically A with respect to what? B, and then we try to derive the formula, and using that formula we arrive at R, and then covariance. This is actually covariance from the this part we have arrived the formula here. That becomes a formula. RAB into standard deviation. This becomes. Now this 3 standard deviation formula is very common because we'll be using a covariance instead of the A, C and R part. That will be very, very common when you move forward. Now problem with the standard deviation formula comes is, you have, if let's suppose it keeps increasing 4, 5, 6, then you have a problem of this R, and the formula will not be so straightforward, because 2 and 3 would be still manageable. After that the problem becomes problematic, and hence we have a concept of the beta which comes in. Let me go to the beta, which is the most important part of the chapter which comes out. These are the methods to calculate beta. Beta is the most important part which to touch in the chapter. Methods to calculate beta. Based on covariance, it will be covariance. It's a beta is a relationship between the movement of a stock and a market, that captures a movement of a stock and a market. So we have SM divided by variance of market. The second is based on correlation, or you can say standard deviation. That's RSM into standard deviation S. Actually this is the derivation from this formula, because R formula is covariance divided by standard deviation of S and market, and the covariance would be RSM into standard deviation S and market, and using that formula when we apply, we arrive at a formula of RSM. Actually higher the correlation between the market and the stock, the beta would be higher. Higher the relationship between them, beta would automatically be higher. So R captures the relationship, and this captures the risk in the form of a beta, this method. Third is the logic form, which we have been using in the derivatives a lot. If the beta is 2 and market changes by 10, we say the stock will change by 20. So the formula becomes, which we used in some questions in the derivatives also, percentage change in the security return divided by percentage change in the market return. That could be a possibility. I'll be using these formulas in some of the combinations, because there was one question which is based on the controversy which I have missed out, not taken here. Now before, since we have touched the methods to calculate beta, let me discuss this concepts with you. Based on this, we'll be applying this formula also, this formula also. In case you are given the entire number calculate, then covariance is slightly smaller step, because in the based on correlation you have to calculate standard deviation of market and stock. So if by chance he is asking about systematic, unsystematic risk, then you would be left with no choice, but you will have to calculate these numbers. In case he is not asking about systematic and unsystematic risk, let's suppose, then there is no problem, then you can finish off your answer here. I think one question I would have taken in which both the methods application would have been there. Before we go back to the critical part of it, let me cut. We have ample number of questions. Let me come back. First question, which could link in fact question number 38. That's the easiest of the question, which will link between the security valuation chapter and portfolio. Solution 30, question 38. Let me read out the number with you. An investor is seeking the price pay for a security. Investor is seeking the price to pay for a security. So standard deviation is 3%. Standard deviation is 3% of a security. This is standard deviation of S. Coefficient correlation for the security with the market is 0.8. R. The market standard deviation is 2 point. Market standard deviation, that's standard deviation of market. Return from the government securities RF. Market portfolio RM is, investor knows that by calculating the required return RE, he can then determine the price to pay for a security. What is the required return? Actually, let me now, since we are portfolio, the KPM model, whenever you are given RM, RF, CAPM will apply. Please remember, for the purpose of CAPM, technically what you get is something called RE, required return. Interchangeably you can use KE, you can use ER, but the correct way is RE. In case by chance you go for the interview and then say KPM will give you what, it has to be the required return on this RE. There is a technical difference between RE and expected return. There are questions which comes on that also. Expected return is basically what is your requirement and what is your expectation. Both can be different. So expected return practically I can read as kind of an actual, and RE is what is my necessity. So RE is, if he uses the word RE, it's okay. If he is not using these words, then you simply write KE or ER, it's one and the same thing. It does not make a difference. So my RE would be here RF plus, basically what he wants to know from us is, he wants us to calculate the RE, and that then he wants the calculate the price of a security. Actually price of a security is, if you go back to your the security valuation chapter, formula used to be D1 divided by RE minus or KE minus G, that formula. So this is, he is not asking, he is giving a hint of that. In second question I'll ask you. So in the first question he says, investor knows that by calculating the required return RE, he can then determine the price to pay for a security. That means in this case I have to calculate RE, RF I know, RM I know, RF I know, beta I need to calculate. Beta in this case would be equal to, since we are using what formula, R formula, R SM, standard deviation of what, security divided by deviation of market. R is given as what, 0.8, standard deviation of securities market, point, how much do we, 1 point, 1 point. After that you can apply the RE formula. RE would find 1 minus 5 point, how much do we get, 10 point, 10 point. Now next question what I'll cover is slightly lengthier, in which we'll do the entire security valuation concept also and same formula. The seventh. My expectation is at least you should be doing calculation on the calculators. XYZ Limited paid a dividend of 2 per share. Paid is D 0. The dividend is expected to grow at what rate? 40% for the next 5 years and 15% thereafter. That means you can calculate D1 dividend growth model. You know how do you calculate? 1 year, 2 year, 3 year, 4 year, 5 year, and then 5th year till infinite I can apply what? Perpetuity. Basically he is giving me a hint to apply dividend is expected to grow at 40% for next 5 years. I can calculate D1, D2, D3, D4, D5 and then P5. The return on 182 treasury bill is 11%. Market return is expected to be around 18. This is given as what? RMN RF. Variance of 24%. I am not debating on it. This should be percentage square or percentage. Basically, standard deviation to standard deviation should be a percentage. For example, I ask you to convert this 24% in points. How will you do it? 24 divided by what? 100.24. Very good. The debate I will not do it, please. It's something we cannot help it out. Standard deviation is 2%. What will be standard deviation? Let me put 4%. Let's suppose, by chance, if you put this in point term, 0.02, right? Then put standard deviation square, 0.02 into 0.02. How much? 0.004. Convert this into the point form. Understand what I am trying to say? Variance should be, I don't know, what should I say and write? In exam, he writes percentage. My opinion is, if he write just variance 24, because if someone tells to convert variance in the point form, it will be divided by 10,000, not be divided by 100. Understand what I'm saying? How would you get 4? You'll get 2%. You'll get 2% into 2%, na? So point wise what? 0.02 into 0.02. You're dividing by what? 10,000. So if you divide 4% and say that I multiply 2% into 2%, I get 4%, that technically is wrong. Reason being, because in one of the questions, I again, the book would be there, I have not taken it. He has given the variance in the point form, 0.0004, 0.0024. If by chance you have to convert point, for example, if I ask you convert this in the normal form, you will multiply by 10,000, then it will come 4. So be careful in the exam. If by chance something is in the variance form, if something is the standard deviation form, it's 2%. When I say 2%, convert in the points, you simply divide by what? 100. If I have a 2% and 2%, you divide 2% by 100 and 2% by 100. But when you multiply 2 into 2, you cannot do 4 divided by 100. It has to be 4 divided by what? 10,000. I hope you are getting my point. So although technically I don't think any problem has arisen till now, because either he has given all data points in the point or all data points in the percentage. But when you look at practical life, when you go, so if by chance you have to do, this is actually a variance is a square form. So anyhow, if by chance it had to be converted into points, you should be careful during that point. If this problem has not arisen till now, again the covariance of this is of the market is 30%. It cannot be again the 30%, because when you apply a formula, covariance by variance of a market, when you apply a formula, since it has written both in percentage will get cancelled, otherwise that should be a percentage square divided by percentage. That these are some common problems of the answers which comes out, and throughout they will not improve, they will not change it also what comes. You are required to calculate the required rate of return and intrinsic value of the stock. And intrinsic value of the stock. Now basically this has moved a slightly step forward. In the previous question we calculated R by using a formula, we calculated beta using a formula, because actually when you read required return, formula is RF plus beta into RI minus RF. You need the calculation of beta. In the previous question, beta was correlation into stock standard deviation divided by the market. In this you have a covariance divided by variance. So my beta calculation of x, y, z, if I try, the covariance, the formula is covariance of a stock or market relationship, that 30 divided by the variance of the market. This gives how much? 1.25. And then what I'll do is KFM. RE would be, how much is RF? 11. 1.25, 18 minus 11. Let's not look at the answer verbally. Shortly we do the answer. Format I'll show you. How much do we get? 9.75. Now since he is saying calculate the intrinsic value, which model to apply, sir? He has given what data in the first two lines? Dividend. That means if you recollect, it's a D1, D2, D3, D4, D5. Let me draw the diagrammatical presentation and then we can bring it back. Formula, the answer I'll show in the slide, don't worry. So let us try to draw 1 year, 2 year, 3 year, 4 year, 2, 1, 5, 5th till we have D1, D2, D3. Just do it as a practice, please. And from here to here, 5 till in. So what was our, he gave us D0 na? What was D0 given? 2. If D0 is given as 2 and he said how much is the 40, 40, 40, finite was, get 40% is what? 2.8. Second one, 0.9. Then 5.4. Next one, 7.76. These are D1, D2, D3, D4 and D5. D5 would be, sir, D5 10.76 in 1.15 divided by, we got RE as 19.75, 0.1975 minus 0.15. You can get P. How much do we get? 260. It's 10.76 into 1.15 divided by 0.0475. 260.51. Now you will have to bring it back to what? And please do not include the D0 value. We never include the D0 value. Bring it back to what period? 1. $19.75 discounting factors. Discounting factors are 19.75. How much do we get? 0.58. 486. 0.835, 0.67, 0.582, 0.486. 0.40. .8 into 0.835, multiply and tell me now exact total. Get in value 120. 122.14. Now presentation wise, if I show you how the answers you present in, we calculate beta of xyz, covariance by variance of market. Beta comes 1.25. Then you calculate RE 19.75. Intrinsic value 0 is nothing but D1. You calculate 4.5, P5, and intrinsic value 0 would be get 120. 120. Another question which on this has come in the exam twice is the ninth. That's simpler. Ninth. The following information is available in respect of security A. Equilibrium return is 12 percentage. That means it's RE basically. If your return is same as a market return, your beta would be equal to 1. One way of calculation of beta. 6% treasury bond trading at 120. Using this data also we can find beta, that will see. Or if we can find it, then we can find beta. We'll come back at covariance of a market return and security return. That's covariance. Coefficient of correlation 0.8. You are required to determine the standard deviation. You are required to determine the standard deviation of a market. That means you need to calculate standard deviation of market, standard deviation of a security. Standard deviation is of a return only. You need to calculate standard deviation of a market and security. You have been given correlation. You have been given what? Covariance. You can apply a beta formula is covariance by one formula we can apply, because from here we got beta 1 na? 1 I can apply covariance by variance of what? Market. Covariance, how much do we have? This I know is 1. Covariance is 196. My variance of market, guys, I can find my variance of market 190, and he said calculate what? Standard deviation 190. And once I get that, then I can apply the second formula. Beta of security share and the market is equal to R divided by market. Beta is 1 point. I don't know market is. I'll get what? 17 point. Basically, he has checked application of both the formulas. He checked application of both the formulas. So what was the use of 6% treasury bond trading at 120? I'll show you what was the. We could have alternatively used data to find RF, and then using the data to find beta. That could be there. But straightforward we can write in the exam is, since your equilibrium return is same as what? Market return. Since your equilibrium return is market return, beta would be equal to what? 1. Let me go back and we have, since equilibrium return is equal to market return, beta is equal to what? 1. And then using beta, covariance, variance, we find variance of a market and standard deviation of a market. Using beta, we find standard deviation of 17.5, and alternatively, this is the way of finding beta. RF bond valuation we have done. If any security is trading at a higher than the par value, that means the return it's earning 6% return. That means normal RF would be a 5% return which comes out. So as per KPM, you have 12% equilibrium return, 12% market. They have given 5, and you can reverse calculate beta. Data is 1 only. To try this data also, you get answer as 1 only. Now next question is the entire practice of calculation of the beta. What could be the lengthiest of the exercise to calculate beta? My expectation is answer I will show you. Since we are in the fast track mode, it's okay. But please calculate with the calculator so that you have acceptability. I have tried to calculate by both methods. In exam, do it by one method. I have tried to done it by both methods. In exam, you can do by one method. Let me go back. Question number 43. Number 43. the rates of a return on security of a company X and market portfolio for 10 periods are given below. You have been given period, return of a security X, return on a market portfolio X. Since they are given historical data, it's a historical data which is available. This is X data, this is market data available. Now I have to calculate the beta. There are two formulas for beta what we learned. One is using a covariance divided by variance. Now let me put out data, and second by the standard deviation. So what I'll do is, how the data would be presented. If let's suppose this is X data, you'll find first X minus bar, that is X. Now d square X is not required if you use the covariance by variance of market, but I will use in my data because I want to use the standard deviation formula also. Then next you have what data available? Market. You will find deviation of M. D square of M is required because you require variance of the market. And then dx into dm. Dx into dm will give you the data for what? Covariance. So if you use d square x, you can find standard deviation of x. With the d square m, you can find variance as well as standard deviation. So if you use a formula covariance divided by variance of a market, you will use this data and you will use this data. And if you use standard deviation, then in that case you will have to calculate R also, standard deviation of X also, and something of that. Cross check the number. Important part which I was telling to you in the beginning of this chapter was, when you are doing this here, please make sure when you are doing the sum of this dx. Let me show you this data how to do it because it's in one slide. Then you try your own calculation and check it out please. I want at least some calculation. This X data is available in the question. Just keep looking up. X data is available in the question. Total is 150. You will find X bar 15. Then you will find dx. Dx is nothing but 20 minus 15, 22 minus 15 and so on. What I need from you is, when you do in the exam also, please make sure the sum of this should be equal to 90% chance is there you will make a mistake at this level only. If this is not coming 0, do not go forward because all calculations going forward would be wrong. That is how chapter becomes difficult. D square x was not required. I calculated because I have applied the second formula also. M was given. Total of the M is 120. I find M bar. Then dm, d square m, and then dx, dm for covariance. Look up please once. First I have applied is covariance. So I have calculated covariance is nothing but this is this formula divided by 10. 10 periods are there. And then variance of M has been used using what? 60706. Where M by this. And then beta of the security, what I originally used formula was covariance of XM divided by variance of market. The question ideally was over there. That's it. The question was there. After that, what has been done is, sir, I have applied a second formula so that you can cross check the numbers also. An application of both the formulas you can do in one question. I need standard deviation of a market. Since I have variance of a market 70.6, I'll do what? Under root. Standard deviation of X, I calculated this 1148. So 1148 divided by 10 under root. R formula I need because second formula is R into standard deviation of a security divided by. It becomes slightly lengthy. Hence we generally do not use unless and until required. R is covariance stock and market divided by this, and then we apply. We get same this part here 0.50. In fact, even if he would not have asked me to calculate, look up please. Second part is asking a characteristic line. First part is asking calculate beta. The question is genuine enough. Generally he'll do what? He can directly ask you calculate characteristic line. That means without beta you cannot find that characteristic line. Another point he can do is, he can ask you calculate characteristic line, then systematic unsystematic risk. If you have to do that systematic unsystematic risk, then anyhow you have to calculate the standard deviation of stock and standard deviation square of stock, which will be learning the subsequent parts. In this part it was not required because for characteristic line you need a beta calculation. So for beta he specifically asks, or do not ask, you have to calculate the beta. Beta can be done. Shorter formula is covariance by variance of market. It saves some data points for you, at least this d square x and the correlation. But if by chance he is asking with the characteristic line systematic and unsystematic risk, which he has been aggressively using now, in case he is asking that, in that scenario you will have to calculate the standard deviation of stock also. What I expect from you is just do the calculation, so that when you home you look at this slide, it does not look strange to you that how the calculation is done. Again I am saying what I did was x, the total number came 15, x minus x bar, 20 minus 15 5, 22 minus 57, and so on. These numbers were calculated. D square x I have left the blank. If you want to do, you can do is 5 into 5 25, 49, this 100, this is 6, this is 6, this is 400, this is 4, 9, 3 into 3 is 9, okay. 400, then 4, 15, this is 4, 22 into 22, 484, and this should be. Quickly cross check both the formulas, then we move to the characteristic line. Please check it out, please. Once you check the numbers, let me know. Discuss characteristic. That leave 12 lines is approximately for the characteristic line only. Check the formula. Both formulas has been applied. So where do we apply that logic formula? When you have two data points. For example, two data points are there, now you can apply. When you have more than two data points, you cannot have a straight line relationship. Understand what I'm saying? For example, I say market moved from 20 to 30, stock moved from 15 to 25. Only two data points, and when the madam would have told you in the junior classes, when you were doing some graphical presentation, and madam used to tell you this is their movement of x, movement of y, movement of x, movement of y, and you used to draw what? Straight line. But when you have more than two data points, you cannot have a straight line. We call that as a best fit line, and that is exactly what will become a characteristic. Understand what I'm trying to tell you is, when you have two data points, if you would have done some graphs now, the same thing we are doing, it's only we are naming it differently. So the second part, when he says, actually second part he says draw characteristic line. The characteristic line is nothing but it will show a relationship between a return from a security when the return from the market changes. So the beta would be a constant and there will be some intercept. That means where does the line, for example, if where is the line gone? For example, if I have two data points, I say if this is my x value, this is my y value. If this is my x, I say if this is my x and y value, that means if x is here, y would be here. And then I say this is my, if x is here, y is here. And then you used to take a scale, small scale. If I draw like this, line becomes straight line, two data points. This line has to cut somewhere. The characteristic line actually is a kind of a statistics line. So it will cut somewhere. We say if this is market return, although he'll not be using m and these terms, he'll be using some other term. I'm using this is y, this x term. X is a, actually x is a security in this question, so do not get confused with that x. X here is if the market changes, how the return from the security changes. So we have a constant return here. We say if market give this return, if market is here, what is the return of the security? Market is here, what is the return of the security? But when you have more than the two data points, it cannot have a straight line relationship, and hence comes the concept of characteristic. Can be important theory question also. Just have a look at this. I'll explain to you. In exam, you just have to make an equation. Characteristic line is a statistic line. You have some other line also. For example, KPM, the SML, security market line. The SML line will always start above 0. Characteristic line can start anywhere because it's not a finance line. In the finance, we say at a 0 return, I need a minimum return. Characteristic line is showing a relationship between a return from the stock and return from the market. It can be possible, for example, we say x is return from the market, y is return from the security, and if I have two data points, I draw two data points, draw the line, it cuts here, called intercept alpha. It's a regression line, and it says if this is 0, what is the return from the security? Because market can give 0 return. If I put return x is a market, if I put 0, the beta into market is 0, y would be equal to a is nothing but this part here. It can cut here, it can cut here. It could be possibility when market is giving a 0 return, your security can give you what? Negative return. It's a possibility. So please do not get confused with the lines. It's a junior class line. Maybe 5th or 6th class you would have learned. Exactly same line is there. We are just giving this some naming convention of the CA final. You can say a slope function, someone says a regression line, someone says a statistical line. For me, it only shows if the x is this, y is this, x is this, y is this. Since we have more than one data points, we cannot have a straight line relationship. So if you look at this line here, we say the data are falling near the away. It's a best fit line. For example, if I draw two data points and there are more than data, if I put this, you know what is the meaning of this dot? What is the meaning of this dot if I put here? It means if the market is giving this return, security is giving this return. If I put here, it means what? Market is giving this return, security is giving this return. If I put this, it means market and security. So we are trying, there could be possibility, point could be here. A point means market and security. If I put a point here, it could be market and security. So how will I draw the line? Drawing is not possible. We try to draw what? A best fit line. Basically in which we try to cover all the points. So when we say this line is basically a best fit line. It shows that this was the return of the market stock. If these points fall near to the line, something comes up which will be talking. If they fall near to the line, we say correlation is stronger. Actually, I have not shown the correlations data and so on, but the objective of this line is the relationship is stronger. If they fall away from the line, relationship is weak. So we can make to some other extent. Second important point, if the relationship is stronger, there could be possibility systematic risk could be stronger. If the relationship is weak, there could be possibility unsystematic risk could be there. That is something random error, which we call it as. There could be a possibility. I'll show you some other graphical presentation. I might not have taken a slide because slide was not beautiful, but I'll show you from my data points how exactly we try to look at that data. So we compare using this n number of observation we can do from your point. You just have to remember, even if you do not know security, you say if x is moving this, what is the return of y? If x is moving this, what is the return of y? So, but you have to know where would it cut on the axis. It will cut somewhere axis. This is a. A is a constant number, b is a constant number, beta here, and that comes x. The same exercise I'll do in some complicated part. You will be surprised to know that one of the PhD level questions which has come in an exam can be done by using this equation, but I will not be using this term a, y, bx because that's for a characteristic line which comes. Do not get confused with this question. X was a security in this. So if x is here, we say it's a regression line. It shows relationship between stock return and market return. And when you use this language, stock return and market return, you're actually talking about what? Beta. It's a movement between both of them. Y is return from security, X is return from market, B beta coefficient, A alpha intercept. The plain vanilla language is its return from a security when return from market is what? 0. That means if market is giving you 0 return, then what is the return from the security? Or you can say where would it cut somewhere? There has to be some number. It could be positive, negative, both, because it's a statistics line we have. So if there are two data points, we can say it's a straight line. If points follow a line, beta is constant, or you can say slope, etc., whatever we use. If there are more than two data points, it could be zigzag line. If points do not follow a line, we draw best fit line. CL is the best fit line between a stock return and a market return. It's a best fit line. Now exams, sir, we have to do this much. Exam you do not have to do. While teaching extra, we have to explain this. What I need is, have I calculated beta? Yes. In exam, when he says characteristic line, you have to calculate beta, a constant number, and then a as a constant number, and then leave y is equal to a plus x. That shows if the x moves, what is the return in y? If x moves, what is the return in y? For example, in our question, what we had was, the data was not there. We left some line here in our question. Second part, he says what? Equation of what? CL, na? Equation of CL. So if I try to put here equation of CL, y is equal to a plus bx. Beta we calculated 0.506. Now y, and please remember, x is not a security here. Data x was security. If you want to put, you can put y is a security, x is a market, b is beta coefficient, a is the standard straightforward number, that constant number. So y is a security. We want to find how the movement in the return of the shares will come if the change in the x comes. Now I have beta constant, I need to find a. What we'll do is, we'll assume if your return of the security was 15, if your return of the security was 15, and if beta is 0.506, return of the market was what? Average 12. It is not constant number, average 12. Then what would be a? Calculate that a, please. 8.928. Now therefore, the equation of CL in exam answer will finish. Equation of CL, y is equal to 8.92 plus 0.50. Sir, how do we read this? If I try to draw, this is not for the exam. If I would have drawn a line chart, I would have said this x is a return from the market, y is a return from the security, x is return from the market, y is return from the security, and where do we cut? 8.928. If I draw a line, this is 8.928. That means you make x as 0. Means if the market return is 0, the return from the security would be equal to what? If the return from the market is 0, return from the security would be? Return from security would be what? 8.928. 8.928. That is the meaning. That is exactly this equation. Sir, it's a basically it was not a uh, the straight line because we have calculated our numbers on the average in 15, and that's the data. In exam you just have to leave it here. Y is equal to 8.928 plus 0.50. Fine. Now let me move to next part. Before we move to the next part, let me do with you systematic and unsystematic risk. Now total risk. Total risk. Equal to systematic risk plus systematic risk and systematic risk. Actually, when we read systematic risk, general languages, if I use a very general language, it is that part of total risk which cannot be diversified because it has link with the market. If there is a risk in the market, there is a risk in the security. You cannot diversify because that risk is because of the market. Unsystematic risk is that risk which can be diversified. Systematic is risk is basically a macro level risk. Unsystematic is a company level risk which comes out. It's a company level risk. Let me show. I have that. Now look at this part here, please. Using this definitions, I'll make my formulas also. Total risk is systematic plus you will not have that slide, don't worry. I only have, so you get from here only. The first 3 points are very basic points which generally we can say or explain to someone. Systematic risk is that part of total risk which cannot be diversified, cannot be reduced. Unsystematic risk is that part of total risk can be diversified. It is macro level risk. It is second is micro level risk. The foreign exchange, inflation, interest rate problem, so on is captured by the systematic risk. The unsystematic risk is could be a product problem, management issues, or what we have funding issues in the Vodafone idea, that could be unsystematic risk because that's a company level risk. Now when something is a company level risk, I can basically reduce or diversify, or I can move away from there. I can shift to some other company. But if there is a risk in the global market as a whole, no matter which asset you invest or which company you're investing, have that risk present. Now second two definitions what we have basically will explain the way how do we write the formula. If I write systematic, it is that part of total variance. That means answer will come in the variance form. It is that part of total variance, and do not get confused. Simply remember, if I write standard deviation A, it's a risk of a security, standard deviation of a security. If I say this is nothing but total risk, but in standard deviation form, if I calculate the standard deviation square of A, which you can easily do because you know how to calculate standard deviation square of A means it's a total variance of that particular security, which is explained by variance. This total variance, it is total variance which is explained by variance in the market return. That means we have to create some formula in such a way the relationship of the total variance in the market attached with this particular security will give a systematic risk. It is that part of total variance. It means out of this, the part which has relationship with the market, basic languages, which has relationship with the market is nothing but systematic risk, and which is explained by variance in the market return. We'll try to create a formula, don't worry. Then if I talk about Unsystematic risk, it is that part of total variance which is due to the stock specific. Unsystematic risk we cannot calculate. Unsystematic risk is always a balancing figure. Could be a possibility in your exams he gives the data and he says unsystematic risk is this, and you start wondering how did he calculate. He did not calculate. He can calculate. Can he calculate standard deviation square of A? Yes, that's called total risk of A. He can easily calculate systematic risk of A because systematic risk is captured by the beta. So we'll apply some formula beta into the standard deviation market, that gives me the systematic risk of market. The total risk of market, when I subtract that the systematic risk of market, I automatically get unsystematic. But while giving an exam, he can give you systematic, unsystematic, you add up and get what? Total. So there could be a possibility you arrive at that. So when we say what are the names used, is unexplained variance, residual variance, or balance leftover, and this is also known as the explained variance. That means we can easily calculate. Now using this let me create my formula only. Let me create formula only. Look up please. Try to create. We say this is the total risk of A. If formula is giving you problem, read in the language total risk of A in the variance form. First of all, answer will come in the variance form. Variance form we cannot speak the way I can speak standard deviation. So anyhow we are not talking in that any sense, we are just working on the numbers. Otherwise standard deviations we can talk very easily. The variance we cannot talk very easily because they are in the standard deviation square form. Difficult for us to speak on that number. Now out of this number, if I calculate my systematic risk of A, if I put here, it says it is that part of total variance. That means it is that part of total variance which has a relationship with what? Market variance. That means it has to be captured from the market variance. Since it's in variance form, it will variance, and beta captures the relationship of a systematic risk with the market. So formula becomes is beta square of S into standard deviation square of M. The books might use I or some other terms. Do not get any confusion out of that. What we are trying to say is, if A has total risk, that means there is risk in A. Out of that total risk in A, what is systematic? Systematic is that risk which shows relationship of market and stock. So relationship of market stock is captured by this into variance of a market, it becomes systematic. Now if I put unsystematic risk of A is nothing but a balancing figure. Unsystematic. Let's suppose if I put standard deviation square of the security is what? A. This S is nothing but security. So I can put A only here. A is a security here. If I put A and I use a random error, this is out of this, it's unexplained. Not actually kind of a E I am putting in, it means it's representing in notation form. So out of the total risk which is unexplained is this part here. Can we calculate? We cannot calculate. We can calculate total risk of A. So I can calculate total risk of A, which can be calculated. I can calculate the systematic risk of A, automatically will get unsystematic. There could be possibility, some books, some notations will find A into this or I into I, and then they'll write this formula instead of A, they'll write standard deviation square to the power IE or something symbol like E, that only represents as part of unsystematic risk. And if I try to put, it's called random error. This represents a kind of a random error. That means it's a stock specific risk which is representing. So what we are trying to do is, if A is security, then out of A, how much is unsystematic risk? How will I define? Either I write unsystematic risk of A or I can denote by some symbol. When they denote by some symbol, actually they get unsystematic risk of. This formula you have to remember. That's it. The systematic risk of. This formula you have to remember. Sir, can we calculate the standard deviation square of A? You can easily calculate the standard deviation square. That could be. Now, let me look at a small question framed. Have I given you question number 34? 34? At 34. Following are details are given for X and Y companies stock. Bombay Sensex market for a period of 1 year. Calculate the systematic and unsystematic risk of the companies. Calculate the systematic and unsystematic risk of the company. Stock. Have total risk is systematic plus total risk is systematic plus systematic. X we are finding now. Let's find total risk of A is what, sir? Variance of return. That's nothing but total risk. So if I try my data here, if I put my data here, X, if I put total risk of X, that is standard deviation square of X, is already given in the variance. That is done. Systematic risk of X would be equal to relationship captured by beta of X into standard deviation square of market. Beta is 0.71 to the power 2. Market variance is nothing but it's a variance form given, so do not do to the power 2 again, please. 0.71 to the power 2 into 2.25. How much do we get? 1.1. Then you can find unsystematic risk. Total risk of E means X here minus what is my total risk? 1.6.3 minus 1.5. Similarly, let's calculate for Y also. Similarly, let's calculate for Y also. Y would be total risk of Y available to you. 5 point. Risk of Y would be the square of Y in standard deviation 0.5 or 2. 1.0 5 point minus what? 1.0 point. So there is something given R square, coefficient of determination R square. You can use this also to find my answer, R square. Basically R square is nothing, the stronger the R, stronger is which type of risk, you know? Stronger is a relationship between stock and market. Stronger would be what? You know why? Because if R is stronger, one of the formulas of beta is R into standard deviation of stock by standard deviation of market. Stronger the R, stronger the beta. Stronger beta means which type of risk would be stronger? Systematic risk. So let me do some derivation for you. We could have used alternative as a R square. What does this mean, sir? 18.18 means 18% of the total risk is systematic risk. It means 18% of total risk is systematic. Let me do something for you. Small note, if you want you can put, otherwise I have already have. Which concept? Fast track. I think you will not have this like have no, not then very good. Look up. Systematic risk as proportion of total risk. Systematic risk formula is what? Beta square of a security, standard deviation square of a market. Numerator is systematic risk. Total risk is standard deviation square of a security. Total risk is nothing but it's a security only. Beta formula is one of the formula. Beta is R into standard deviation S divided by standard deviation market. This is one. So what I do is instead of this beta, I substitute this formula here. R into standard deviation S divided by standard deviation market to the power 2 into standard deviation square market, and this was security as it is security. When I solve the numerator part, we get R square into standard deviation square of security by standard deviation square of market. This gets cancelled, and then I get S also as gets cancelled. I get R square. Basically, we represent systematic risk is by total risk is R square, called coefficient of determination. Way of reading is if R is 0.9, we read is 0.9 into 0.9 is 0.81, that is 81% of the total risk is nothing but systematic risk, R square. 81. The question what we were doing in that R square was given what? 0.18. It means that 18% of the total risk nothing but systematic. That means if the stronger is R, stronger would be R square. Stronger of a R square would represent systematic risk as a proportion of a total risk would be stronger. That is how exactly the derivation is done. What you can do is you can just put down systematic derivations. Anyhow, last stage not required. If you want, you can go back home, reopen this and copy down. Otherwise, just put this formula systematic risk by total risk, because in question he might give you only this part R square and then can ask you to calculate, or maybe in an MCQ he can give you that R square is this, what will be the proportion of systematic risk as a proportion of total risk and so on. Anything he can give you. We call this as the coefficient of determination. 81% of the total risk is equal to the now the question number 34 which we're doing. Once you have copied this part maybe and only part reading for how to read. Question what we are doing, we can go back and we could have done shortcut also. Could have applied shortcut. Let me know what. Back. This case X at 18% na? Say 6.3 into 0.18. How much do we get? This exactly will say 18% of the total risk of X is equal to 18% of the total X. Fine. Now one question I did not take for specific reason because calculations are very weird. What I can show you of residual and this, so that when you go back home you revise it and discuss slightly faster mode, because objective of this chapter was not to, although I have taken one question in almost entire revision of the chapter in the way, one question we generally cover class in which slightly lengthier. I have not taken it, but let me one thing, I'll back home and calculate. Fact 1, formula of the covariance there. If it that comes, I'll show. Very weird. Look at this question. 66. Discuss with you so that when you go back home, because this question has come 2 times in the exam, I think, and question has very weird numbers. Be comfortable doing those numbers. Question is common. It's not. You will not be able to find it out. Let me. That I can. In whichever book you have or whatever authors you are following, they would have this question. Let me just do it roughly with you. Answer also I'll show you. We have following are the details of a portfolio. Actually, I was telling you that the point form, for example, percentage. This when they give, look at here, they give total variance. So this is actually they have genuinely given. It is not 0.15. They would have divided whatever the number was. They would have divided by 10,000. So let's do everything in point, because the moment you convert in the percentage, you will make a mistake. So if he gives variance in the point form, try rest percentage data convert in the point form, because there could be very high chance you will end up making a mistake. So we'll avoid that, will not make that mistake. So we have a share, portfolio weights, beta, expected return is in percentage, and variance is in the point form. Standard deviation of the market portfolio return 10. You are given the following data: covariance A, B, covariance AC, and covariance BC. Calculate portfolio beta. Let us do it verbally. Few answers. Portfolio beta. Portfolio beta, how will I do it? Is just simply do on the calculators. Apply your calculation skills. 0.4 into 0.2, 0.5 into 0.5, 1.1 into 0.3. 0.66. Residual variance. Residual means unsystematic. This is the word of each of these. Now, total variance, you know what is this actually? This is standard deviation square A, standard deviation square B, standard deviation square B. That is total risk ABC. From this, if I subtract what? Systematic risk. I'll get unsystematic risk. No? Let's do systematic risk. Systematic risk formula is, I've just put one formula here. Systematic risk is, sir, beta square A into standard deviation square of a market. So A I have taken 0.4 into 0.4 into 0.1 into 0.1. I got what? Just check. Are we getting 0.0016? 0.0016. Then out of the total risk, look up please once, because I'll ask you to do at least these two numbers. Out of this 0.015, this is total risk, minus 0.0116. This I get what? Unsystematic. Unsystematic this I get. Can you do it for me? The systematic risk of B and C. So how would we calculate? Once again, it will be beta square of B into market. I'll just put it here. Systematic risk of B. Systematic risk. I'll take the numbers from. Sir, once again, beta into 0.1 into 0.1. How much do we get? 0.0025. Now the problem is we cannot read them out. We can know it's a systematic risk since it's a variance form. The better way of reading is not there. It's a systematic risk. That means it represents risk which is attached with the market. Systematic risk of C, sir, it will be 1.1 into 1.1 into 0.1 into 0.1. 0.011. Now what you can do is from 0.025 minus this, so you get unsystematic risk of also 0.0225. When you go back home, you will find this question. Don't worry in your books, just so that it helps you in revision. Systematic risk of C would be, sir, unsystematic risk of C would be, it will be equal to total is 0.100 0.100 minus 0.0121, 0.08. That's done. Third part, there could be a challenge. He says variance using Sharpe index, portfolio variance on MPT by Markowitz. Basically, that's a standard deviation of portfolio consisting of three securities. We'll come back to it. This is total risk of portfolio systematic plus unsystematic. This could be the area of a mistake. Now, when we say a systematic risk of portfolio, systematic risk of portfolios, have you calculated the portfolio beta here? Basically, when you say systematic risk of A, you do beta square of A into standard deviation square of market. When I say systematic risk of B, you do beta square of B into standard deviation. So this will be beta square of portfolio into what? Standard deviation. Beta square of portfolio into standard deviation square of market. Systematic risk, how much do we get? Very weird number would come. It's okay, let it be, and keep in point, because the moment you will convert in percentage, you will make a mistake. It's 0.66 into 0.66 into 0.1 into 0.1, 0.0045, 4356. This comes. Now the second part is 90% chance if you make a mistake, you'll make. So how would we calculate unsystematic risk of? There is no correlation between them. There is nothing. Do you know the? I am using a green color now. This is unsystematic risk of what? A. This is unsystematic risk of what? B. And third, this is green. What I've encircled is unsystematic risk of what? C. Now, if I have to find a portfolio, I'll multiply by what? Weights. When you multiply weight, please multiply by weight square. Understand why? Reason being, this data is in which form? Actually, you did not realize when you do standard deviation square A, weight square A, standard deviation square B, weight square B, plus 2 standard deviation weight A, standard deviation B, weight B. So basically, square form you are using. Is this unsystematic risk is in what form? Variance or a normal form? It's a variance form. So if it is a variance form, since there is nothing called correlation, etc., this is 0.0134. Look up please once, into 0.20 into 0.20, 0.0225b into 0.5 into 0.5, and this into this. That means please do not be in a hurry. Do not simply just do it multiply by weights. Actually, if you look at, everything is systematically fitted in. This was square form, this was square form. Systematic risk also. So unsystematic risk, the unsystematic risk is in what form? Variance form. In a hurry, there could be a possibility you will end up making mistake by only multiplying by weights. So multiply by weight square. So calculate the numbers for me. 0.0134 into, just use the M plus button and I'll take the net number from you. 0.0134 into 0.2 into 0.2, 0.0225 into 0.5 into 0.5, unsystematic 0.014, this becomes so 1 8 calculator, just clearing means May after November, November after May, like RAM clearing is okay. Calculator clearing 0.018. You have these two numbers. 0.044356 was systematic risk, unsystematic risk is 0.4. These are very weird numbers. Now what you can do is, before I show you the fourth answer, you know this covariance was given here. So why it was given? Go back to the standard deviation of a portfolio three securities formula. One of the slides I have given you, I think. This was standard deviation square A, weight square A, square B, weight square B, C, V, C. Life is easier for you because this are already given in the variance form. Then this was plus 2 covariance, weight A, weight B. That covariance was used instead of R, standard deviation A, standard deviation B. We can use this. Sir, what do we mean? What we can do is point A square, weight A square, B square, weight B square, C square, weight C square, plus 2 covariance AB into weight AB, 2 covariance AC into weight AC, plus 2 covariance BC into weight. That's basically this. Although this is modern portfolio theory, this was modern when it was formed. 1960, I think this theory was that time when it was formed. That time modern. So they have been using an MPT. Was question number what we have? 6 now. I'll roughly cross check. Found 0.66. Total unsystematic risk, total minus this. Systematic risk of each stock you found, and then unsystematic risk is this. Then we had a total risk of portfolio, systematic risk of portfolio plus unsystematic risk of portfolio 0.004356, and unsystematic risk, this is the area of a mistake, square form. Remember, if you have a square form, you are using the square form accordingly. And total risk of portfolio 0.018428. And then in this case, since he said variance, the variance was asked, so variance would be A square, weight square A, B square, weight square B, square, weight square C, plus 2 covariance AB, to weight AB, covariance AC, weight AC, 2 covariance BC, weight BC, and accordingly number. So something which I said that how the covariance could be, although there could be one more question done in which they generally arrive at the covariance from formula, because go back home, one question, covariance formula is used beta 1 into, see if it comes at some liters. Try to, this was one part. Now moving into something called APT. Might not have directly would APT, let me discuss. I'll move into that question. I'll just do a theoretical part with you. Do you have 54 question? Just check once. 54. No? Will use one of the PhD level questions. Can you imagine? Here we discuss APT. Actually, APT is a multi-factor model. Like you have a CAPM, that's RF plus beta into RM minus RF. The slide is not there with you. Just read from my slide. APT is a multi-factor model. Instead of capturing the systematic risk at single beta, we use multiple factors. Remember the equation. Remember a equation of CAPM, expected return or a required return, whatever you want to use. RF plus beta into RM minus RF. If the shortcut formula is RF plus beta into MRP. Remember this word MRP. MRP is the excess return from the market when the beta of the market is equal to 1. Instead of beta captures the systematic risk, instead of that, the systematic risk was forex, for example, interest rate, inflation. These are different factors. So if you calculate different factors, then that becomes APT world. In the APT, there are multiple risk factors which can capture the systematic risk, and accordingly we can create a formula. Equation of APT would be same as what we have for the CAPM. Instead of that, we'll have risk free plus beta into 1 FRP1, beta into 2 FRP2. Now how do you read? Make sure you are able to read CAPM. CAPM you read is RF plus beta into MRP. RF is same. Beta in the case of a CAPM is capturing all risk. Beta 1, when I say, it could be relationship of a forex or with relationship of an interest rate. Now FRP try to read as good as MRP. MRP we read is, MRP is the excess return from the market and beta of the market is 1. Basically when you write the RM minus RF, when you write RM minus RF, how do you actually CAPM equation? When you make a CAPM equation, What is the meaning of a K-pump equation? You know what is the beta of a market? Beta of market is 1. If let's suppose RF is equal to 10 percentage, RM is equal to 15 percentage. RF is 10, RM is 15 percentage. I would have this. I take it. That you get comfortable. The moment you are able to read CAPM, the APT is not difficult. Now, CAPM, for example, generally we use a word called KE. RF plus beta into RM minus RF. Beta of risk free is 0. RF is 10, RM is 50. We get this 10 percentage plus beta into 5%. Beta into 5. Now, try to read this number. How do you read? The 5 percentage, how do we read is excess return. Market is giving you how much return? 15. RF is giving you what? 10. You're getting how much extra? 5. Beta of the market is 1. So we say RM minus RF is MRP. MRP is excess return from the market when the beta is equal to 1. So this equation tells me as I change my beta, if beta is 0, this means my return would be as good as RF. If my beta is 0.8, I'll get lesser return than the market. I get 5% extra return at beta equal to 1. At beta of 0.8, I'll get lower return. If the beta is 1, the beta 1 when you multiply here, automatically 5% is at 1 percentage of 1 beta, automatically 5 extra will come. If the beta is 1.5, we say 5 extra I need when the beta is 1. Since I'm investing in a security whose beta is 1.5, I need extra how much? The 7.5, and accordingly we make. And when we draw this in the K-pump equation, it becomes a SML line. That is generally what happens here. Now the 5% you should be able to read. MRP is nothing but excess return from the market when the beta is equal to 1. As the beta increases, return would increase. Similarly, when I go back to my this world now, APT world, we speak instead of the MRP, it is FRP. Exactly same way I'll speak. The beta, what does beta shows? In general language, if I say beta shows relationship between stock and market. So if I say beta 1, it will be relationship between stock and that factor 1, or a sensitivity between stock and factor 1. Basically, beta is a measure of a sensitivity. FRP, how do I read, sir? The way I read MRP, exactly same way I read. We read as factor risk premium, that is excess return from the factor at beta equal to 1. If the beta of the factor is equal to 1, I am getting excess return. If I am having a beta more than 1, automatically my return expectation would be more. That is exactly what it means. That is how we arrive at the numbers. Now let's look at the question what we have, 54. Let's try to look at the 54 we have based on this. Is important from the exam point of view. Actually kind of a PhD level question came in your exam. Analysis has to be done accordingly. When this kind of a question comes, you have to accordingly think about it. There will be a concept of negative weights. Might not have heard something negative weight. It says X owns a portfolio with the following characteristics: security A, security B, risk-free security. Factor sensitivity 1, you can mark it as beta 1 if you want. That's basically beta 1. Factor sensitivity 2, beta 2. And then you have expected return 0.8 and so on in this given. It is assumed that security returns are generated by two-factor model. So basically it's a two-factor model APT world we are talking about. Factors. This is important now. Understand, the moment you understand the first, second automatically you will get. Third was disputable. So what he asked, we'll calculate the answer as what is exactly asking, I'll calculate the answer. And there was a dispute that he asked something else, answer he gave something else. So I'll try to create a fourth part. He says Mr. X has 1 lakh to invest, sells short 50,000 of. Short selling is allowed in the theory world. It is actually short selling. So you have 1 lakh of your own, 50,000 you sold some shares which you did not have. It's as good as a borrowing if I say. as good as borrowing, although we do not call borrowing, but basically it's a you sold and you received 50,000 and purchases 1,50,000 of security A. So total investment was done 150, in which 1 lakh was your own and 50,000 was short selling. What is the sensitivity of a Mr. X portfolio to the two factors? So we have to calculate the weighted average beta, basically weighted average. Now you have the question in front of you, keep the question in front of you. Let me show you how the data presentation. When we put this data, look up please, keep the data in front of you. Answer you will have on slide number 11, don't worry. I have solution in which I say beta 1, beta 2 expected return, we have A, B risk free. Compare the data. 0.8, 1.5 risk free will have 0 beta. 0.6, 1.2 will have 0 beta. Expected return 15, 20 and 10. They own funds. Own funds are 1 lakh. That means these are your own funds. Now how much you invested in a 1,50,000 by short selling what? 50,000. So the weights are, this weight is basically have 1,50,000 divided by 1 lakh, that means 1.5 times of your own funds you invested in A, and the negative weights here is weight of the B, it's minus 0.5. The total of the weight would always be equal to 1. The objective is total of the weight would be equal to 1. You have 1.5 time invested minus 0.5. So basically when you are finding a beta 1, we have to find what factor sensitivities. So if I have to find factor sensitivities, I have to find weighted average beta. Weighted average beta would be weight of A is 1.5, weight of B is what? Minus 0.5. So I multiply, when I do this part here, we multiply factor sensitivity, that is weighted average beta. Beta 1 is 0.8 into 1.5 plus what? 1.5 into minus 0.5. Second case we have 0.6 into 1.5, 1.2 into what? Minus 0.5. That's exactly 0.45 and this is weighted average. Basically this is weighted average beta, nothing else. So we get this part here. Just remember this part, sir. That means whatever we are investing here will divide by own funds. That's basically will give you the weight. Total of the weight would always be equal to 1. In first case you have a weight of 1.5 and second will give you minus 0.5. Done that part? Second part, let me. Mr. X borrows 1 lakh at the risk free rate and invest the amount he borrows along with the original amount of 1 lakh. Now he is borrowing 1 lakh more. 1 lakh he had is of his own and 1 lakh he is borrowing. Invest in security B in the same proportion as described in part 1. What was the proportion? Proportion was 1.5 is to minus point. Will invest 1.5 is to minus 0.5. If I go back now and try to check, and then again he's saying factor sensitivities. Look at this part please. 1 lakh he has owned, 1 lakh he borrows. Borrowing will have a negative weight because actually when you investment you will get the return. When you borrow you will have to give the interest. So this will have a negative weight, will come back, don't worry. Total amount, how much I have now? 2 lakhs. And what proportion I should be investing? 1.5 is to minus 0.5. That means investment in A would be equal to 2 lakh into 1.5, that is as good as what? 3 lakh. And short selling would be, sir, what? 2 lakh into minus 0.5. This is minus 1 lakh. So basically if you try to analyze, it will be 3 lakh divided by own funds. It will be 3 lakh divided by own funds. 3 times of your own funds you are investing in A. The 1 lakh divided by 1 lakh minus 1 is weight of B and minus 1 is a weight of risk free. Minus 1. It's always whatever you are investing divided by the own funds you have The 3 times you're investing of your, basically you're creating a leverage position. Leverage basically means is something you short sold, something you borrowed, and 3 times of the money which you had, you're investing in the market. So basically whatever return you'll get from the A, this will be 3 times, and minus 1 time, that means you'll return back for the B, and minus 1 for the risk free means for the risk free whatever interest rate etc is there, you'll have to repay them back. So when I multiply now, it will be 0.8 into what, 3 plus 1.5 into minus 1 and 0 into minus 1. Understand what I'm saying? It's risk free also now. So you'll do 0.8 into 3 because 3 times of your position you are leveraging. 1.5, basically weighted average beta we are calculating. So beta B1 would be equal to 0.8 into 3, 1.5 into minus 1, 0 into minus 1. 0 into minus 1, and we get factors. Only area of a mistake is when you're calculating a weight, it is always divided by own funds. Actually you are creating a combination of, in one side you are getting a return, second side you are giving something from your pocket. So minus is representing on the amounts on which you have to return back, and plus is representing on which you will be receiving the returns. It comes 0.8 into 3, 1.5 into minus 1, 0 into minus 1, it comes 0.9, 0.6 into 3, 1.2 into minus 1, and 0. And question should not be a difficult part here. He told you the proportion, what has to be done. 1.5 is to minus 0.5. Now let me read the third part. First, what he asked, what has to be done? What is the expected risk premium of portfolio? What is the expected risk portfolio? When you calculate RF plus beta into RM minus RF, beta into RM minus RF is the risk premium of portfolio. Basically, risk premium of portfolio, what he wants to calculate is called risk premium of portfolio. Beta into FRP1, FRP2, called risk. Calculate this part here. Risk premium portfolio. Expected return of a portfolio we can calculate is RF plus risk premium of portfolio. This I need to calculate. What I need to calculate? A, I know how much was the return of A, 15%. B, how much is the return? 20%. C, how much is RF, how much is the return? 10. And we just calculated their weights 3 times minus 1 minus 1. That means 15 into 3 is my return. 20 into minus 1 I will have to forgive, or I will have to return back, and 10 into minus 1 I have to repay because I have borrowed in the risk free. So 45 minus 20 minus what? 10. Your expected return of the portfolio is 15. So if I know this is my expected return of the portfolio 15, risk free is how much? 10. I can find risk premium. My risk premium portfolio would be, quickly check it out please. Short selling generally is used in the research works, otherwise short selling practically is not allowed. Cannot do short selling. This portfolio, this was created using such a way in which he was doing a short selling, and using that short selling receipts he was investing in the market. Quickly check it out. Do not get confused with the beta 1, beta 2 and so on. Make sure you are putting the data perfectly well. It's weighted average beta you are calculating. beta 1, beta 2 is representing and only A and B, and you're finding the weighted average beta. That's it. Weights you are finding. Negative weights is basically whatever you are foregoing from your side. And the moment you do the first part, second part will not be tough. Only first part you have to create a combination. Is it fine? Now let us. I'm using one more part here. I'm adding one from my side now. Fourth part, add please. Not there. We are adding fourth part. Calculate FRP2. Actually, I could have taken a separate example, but instead of doing that, we are calculating the FRP2 in this only. Calculate FRP. It's basically we'll use simultaneous equations, what we have done in the junior classes or linear equations. We'll then use that. What is the return of A we have? How much is 15? So I say, in fact, tell me, let me not put here. Tell me what is my expected return formula as per this. It's RF plus beta 1 into what? FRP1 plus FRP2. Formula I have. If I put for A, it's 15%. RF is what? 10. How much beta? 0.8. FRP1 we don't know. No sir. Beta 2 is point FRP2. And this will become sir 5%, 0.8 FRP1 plus 0.6. Equation number. Can we make the equation? E return is what? 10 plus theta was 1.5 FRP 1, then 10%, 1.5, what? FRP. Now I can in fact make solve equation 1 and 2. What I'll do is multiply this in by 2, because this will become 1.2 and this will be solvable. From 10%, 1.6 FRP1, 1.2 FRP. This I'll put as equation. So why did you multiply by 2? So that the equation 1 and 2 can be solved. Solving solving 10%, 1.6 FRP1, 1. You're just solving these, this and this. 1 is solving this equation, .10 FRP1 is coming what? We required FRP2. Put FRP1 in any of the equation, get the answer. Value of FRP1 in equation 1 or 2 of your choice. Value of FRP done. This was tax word for the 10 minutes part is slightly odd. Start. Move to overall beta. Let's write down. We move to overall beta firm beta or asset beta. Two type of workings can come in exam. One is with no tax world. There is no world. We are in. We are in a no tax world. And what we do is beta overall. Beta overall is equal to equity, beta of equity, beta of debt into beta of debt. If question does not specify, then do not take anything, please. If question specifies, it's okay. Question does not specify, the debt beta is assumed as 0. If there is no debt, then overall beta would be equal to beta of equity. And as the debt increases in the capital structure, the risk of the equity holders increases and beta equity increases. Overall beta of two identical firms are assumed to be same. Overall beta would be assumed as same. So if the debt increases in a capital structure, automatically beta equity will increase. But since debt increases and this beta debt would be lesser than the beta of equity, the overall beta will remain same. Practically we use different terms for them. So if I look at the structure of tax world, in the tax world we have formula which comes beta overall is equal to beta overall is equal to beta of equity into e divided by d into 1 minus t, bd into d into 1 minus t, e plus d into 1 minus t. That is standard formula. And then I have done some derivation of it, that why d into 1 minus t comes. It's basically debt is assumed as perpetual and interest should save tax, whereas we apply d into 1 minus t. So debt is assumed as perpetual, and since debt is perpetual, d into I into t, d into I into t, if I go till perpetuity, my present value of tax shield on the debt comes is dt. That's basically present value of tax shield on interest. It's assuming the same principle of d by ke. So d into I is nothing but interest. Interest saves a tax of 30 rupees every 30%. So if you save tax of 30% every year and it keeps on coming till perpetuity, the tax shield present value it comes is dt. So debt after tax shield comes d minus dt, d into 1 minus t. Basically that is why d into 1 minus t comes. That is the reason of d into 1 minus t, that it's a perpetuity of the tax saving on the interest which comes out. Actually this is not the formula what generally we see in practical life. The practical life debt beta is assumed as 0. In your questions also they'll assume debt beta as a 0. If debt beta is assumed as 0, your formula becomes beta overall is equal to beta equity e divided by e plus d into 1 minus t. So if I try to solve that formula, these are the two formulas which you generally see in practical life. Beta equity, it's basically a derivation has been done, nothing else. Beta overall is beta equity into e plus e by d plus E plus D into 1 minus T plus 0, and if I bring O this side, if I solve this properly well, my beta equity becomes beta overall into 1 plus D. This is my first formula. This is called compounding formula, and second formula is this formula. This is called my discounting formula. Second formula, my formula overall. Now overall is beta equity is beta overall into 1 plus D by E plus T into 1 minus T. This basically represents as the debt increases in capital structure, equity beta will increase. This shows the same thing. Equity beta will increase, and beta overall is a discounting effect. Beta equity divided by this. Beta overall of two identical firms are same. Beta overall. Practical life beta equity we call it as beta levered, and beta overall we call it as beta unlevered. It's not that debt is not there. Debt is there, but if we remove the impact of the debt, it's discounting. So beta equity divided by, it's actually, if I put this way, beta equity is beta levered, beta unlevered into 1 plus by E 1 minus. This is the formula. This is the first formula, and beta unlevered BU would be equal to beta levered divided by 1 plus by E 1 minus. You can remember how, sir, compounding and discounting effect. If you look at the first formula, it's basically you are adding the impact of debt. In the unlevered, when you add the impact of debt, it becomes a levered or beta equity is one and the same thing. Beta overall, when you look at this formula, beta overall, we call it as it's a beta unlevered or beta overall, same thing, beta levered divided by 1 plus D into 1 minus T, exactly same. Instead of using the E and O, it can be L and U. First one is your compounding effect, second is your discounting effect. That comes. Derivation I have done it for just for the reference purpose. If you require, that's okay. Beta levered, beta unlevered. These are the two terms what we use while solving it. Now, how the questions would be framed? One of the popular questions which comes in the exam, they can ask actually, it could be when you're doing a valuation of a private company, so there could be some data points given in such a way that you'll have to adjust accordingly. Now, one of the ways of doing it, how to calculate beta levered of a private company, because levered beta depends on your leverage of the listed companies. Let me go next slide. In this case, what we have, this is actually, will not have these slides with you because for the class purpose I required them. Calculation of beta levered for a private company. What generally we do is, these are the steps we'll be applying in the question. We find out the comparable listed companies. This will be given in the question. This is the step which takes a maximum point of a time. So if anyone who is doing practical valuation, this will take a lot of time. For example, it could be a few days, weeks, in which you have to find comparable listed companies depending on the size of the IPO which you are working with. Generally IPOs or any valuation you're doing of a company. Then find out their levered beta. Levered beta would be available and calculate the beta unlevered of these comparable companies. That means you remove the impact of debt of companies. For example, I am A company, there are 3 similar companies to me, and these 3 companies are listed in the market. I calculate their levered beta. Using their levered beta, I remove the debt impact from them. The moment I remove the debt impact from them, it represents beta unlevered. That means that basically if I was also listed and I was in the same way, my unlevered beta would have been as good as them only. And then calculate the average of beta unlevered of these comparable companies. I am a company A and I am a company A and comparable companies are B, C, D. So I am doing a calculation of B, C, D here. Calculate the average of B, C, D, and if the private company was also listed, it can be assumed that beta unlevered of the private company would have been the same as the average of the comparable listed companies. That means if I remove the impact of debt, for example, if I remove the impact of debt from idea and if I remove the impact of debt from the SpiceJet, they become easily comparable within their industry because that represents a kind of business risk. So if you remove the impact of debt, so the business, when you go to the, for example, when you go to when you go in an airline, you never ask them that how much debt you have. The debt is only for the purpose of when anyone is investing in that company. So leverage impacts the equity holders, gets impacted the amount of a debt that company takes. But if I remove the impact of debt, then it represents kind of a business risk. So that business risk exactly depends as, no matter whether it's a SpiceJet or Indigo, they are in the airline sector. The idea or it's a Bharti or it's a Geo, they are in the telecom sector. So when you buy something as a shareholder, the leverage is very, very important. If you're not buying, then maybe you're looking at the unlevered part. So beta unlevered, when we say, we are removing the impact of debt from that purpose, and we are saying if I was also listed, I would have been in the same range. And then if I want to calculate my levered beta, because when I'm doing my KPM valuation, I need this levered beta. If I need this levered beta or equity beta, then I have to find my equity or levered beta, and I'll apply is what? If this was the unlevered beta, I was assuming that my unlevered beta would have been as the industry, and then levered beta would depend on the kind of debt equity I use. So this is called unlevering and relevering. The process is called unlever and then relever. So the levered beta can be calculated. Now how exactly the questions would frame? That means, sir, we have to remember these two formulas. Yes, one, this unlevering and then relevering. Question framing would come as question number 35. I think you have. If I go back 5. Question number 35 we have. It says XYZ Limited is in the manufacturing business, planning to set up a software development company. The project will have debt equity ratio of 0.27. Debt equity ratio of 0.27. That's the debt equity ratio of the business which is planning a new setup. The company has identified the following 4 pure play firms. Pure play firms are similar firms. Pure play firms are firms. Pure play firms, beta levered and debt equity, ABC, DEF, GHI and JKL. These are the pure play firms. Assuming tax rate applicable to XYZ 35%, RF 12%, in 12%, RF has 12%, interest rate is 14, RM is 18. You are required to compute WACC to be used to compute the NPV of the project. Now you just need to calculate WACC, and that will be used for NPV. If you try to analyze question which can be framed basically is, for NPV we need two things. One is WACC and second is cash flows. For WACC we need cost and we need rates. In cost we need KD, KE, and KE we need KPM. For KPM we need. That means what we are doing basically now is we are using the industry data, unlevering, relevering, and we'll arrive at beta. This will help in KPM, KPM will help in KE, KE will help in cost, cost will help in WCC, WCC NPV. That is exactly the entire process which happens. A kind of a case study can come in the exam. As of now, he is only asking us to calculate this till here WACC. So WACC depends on the cost, cost depends on the KE, KE depends on the KPM, KPM depends on beta levered, and beta levered depends on the pure play firms. Which what we'll do is whatever data we have of the similar firms, that similar firms will do is unlevering, and using unlever them, then after unlevering we'll calculate the average of that industry, and then using debt equity ratio of this company will do what? Leverage and relever, and after relevering we'll calculate arrive at this data. Can I go back? Now let me get the question once again. What we're trying to do. We are trying to calculate the beta levered of this XYZ who is planning a software development company. So similar firms are available to you. Beta levered of the comparable company's debt equity. So I'll apply first beta unlevered is equal to beta levered divided by 1 plus by E into 1 minus. I will apply and we'll get the unlevered betas for ABC, DEF, GHL, JKL, and whatever average comes, that average beta unlevered would be again relevered using debt equity ratio of 0.27, and then we'll find what average KE and KE, and then we'll find KD is available, rest data is available. Let's quickly look at the data. Check your calculation. Slide number 12 I am on. Slide number 12 we are on. Calculation of beta unlevered. Have beta unlevered is beta levered divided by 1 plus D by E into 1 minus D. Company ABC, DF, GHI, GL. Beta levered is 1.1, 0.9, 0.95 and 1. Debt equity 0.3, 0.25, 0.35 and 0.6, 0.2. With respect to what? With respect to comparative. Then you find their beta levered. I think 1.1 divided by 1 plus 0.3, I have directly taken 0.65 because 35% is tax rate, 1 minus T. 0.9 divided by 1 plus 0.25 into 0.65, 0.95 divided by 1 plus 0.35 into 0.6, and 1 divided by 1 plus 0.3 into this. Check the calculations. Then what has been done is, this is the total. These are 4 companies. So average beta unlevered is 0.8265. Using this 0.8265, then you relever. Relever is debt equity ratio. He has given what? 0.27 is to 1. 27 is to 1. 0.27 is debt, 1 is equity into 0.65. You get beta levered of that company. Just check the calculation once you do that. KE I can get 0.972, 17.83. KD he gave interest rate into 1 minus T will give me KD 9.1, and then I can find WACC KO is equal to K into weight of equity plus KD into of debt. We arrive at 15 point. Please check the answer please. And if they want to extend, they can give you the capital budgeting question, NPV and cash inflow and cash outflows. You can calculate the. That's the basic objective of this exercise. Quickly check the numbers please. We have done Sharpe ratio, Treynor ratio, Sharpe and Treynor. Jensen's alpha we had not done. To do it, we'll cover Jensen's alpha and we'll cover a cumulative question. The objective of this exercise was unlevering and relevering. This is called unlevering the relevering. Beta, unlevered, levered, these are not my terms. Your institute has started using these, not something which I said now. Your institute has started using. Accordingly, in exam, be careful, please. They'll use this term. Beta unlevered is overall beta, and beta equity is a levered beta. You can simply remember that normal formula also. The overall beta is beta equity into weight of equity plus beta debt into weight of debt, and you can create this formula. Basically, this was basically a derivation of the formula what I have done. In case you, for example, in case you find difficulties or how to remember this formula, in that case, what you do is simply, that scenario, what you do is, instead of doing a derivation, just remember the overall beta. For example, without tax, overall beta is this beta equity into weight of equity, beta debt into weight of debt. If tax comes, this is the formula, overall beta. If you assume, and since this part becomes 0, so the rest part is this, then accordingly keep solving the way you want. Practically, I have done this is practically we use this way. Practically we use these two formulas. This is a derivation of the formula from the top, and how the derivation comes is, I just showed you that this is 0 and then arriving at these numbers I get. In case you find difficulty, it's beta equity into weight of equity, beta debt into weight of debt. If there is a taxation, then d into 1 minus t, that's it. And this part is 0, and you can use this part and then can create your own formulas if you, that's possibility. Fine. Beta overall is nothing but, if debt is 0, beta equity into E divided by E plus D into 1 minus T, and then accordingly that formula comes. And if it says you have to calculate beta levered of a private company or some company, then you have to unlever and relever the beta. Now coming back to Jensen's alpha, we do and we'll cover up the question. Jensen's alpha is RP minus Kpm. RP minus Kpm. It tells you what, sir? It tells you is, if let's suppose actual return is 30 and required return is 21, that means you require 21 and actually you are getting 30 percentage. Then we say it is expected return. Cases are expected return or actual return is more than RE. RE is given by Kpm. Expected return also sometimes we use it, but if Jensen's alpha is there, we say expectation or actually we are earning is more than the requirement. Alpha is positive, intrinsic value will be greater than actual market price. This is called undervalued stock, and we have a buy recommendation. Recommendation is buy. Second case could be possibility you expect 21 but end up earning lesser than it. If you end up earning lesser than it, we call it as the alpha is negative, that's Jensen's alpha. Intrinsic value would be lesser than the market price, and it's an overvalued stock we have. The overvalued stock and sell recommendation. Third case could be possible that you have expected return equal to what? RE. So expected return is equal to RE, alpha is 0, intrinsic value be same as the actual market price, and call it as a fairly. How exactly questions will framed up, I'll see that question. Question would be basically, it could be depending on overvaluation, that you have the overvaluation, you have the undervaluation. Alpha positive means it's advisable to invest, alpha negative means not advisable to invest that company. Let me look at, I think question number 71 you have. 70. The 5 portfolios of a mutual fund experienced following results during the last 10 years period. Portfolio ABCD, annual average return percentage given, standard deviation 2.3, 1.8 and so on given. Correlation with the market returns are given to you. Market risk 1.2 available, that's standard deviation of the market. Market rate of return, risk-free rate 10.1. Beta may be calculated only up to 2 decimal. Rank the portfolio using Jensen's. Let us first think what has to be Jensen's alpha equal to RP minus KPM. RP minus KPM return. Now RP you have there. KPM would be equal to what? If I say only KPM, RF plus beta into RM minus RF. RF is available, RM is available, missing is what? Beta. Beta would be calculated since you have standard deviation of a market, correlation of stock and market, and you have what? Standard deviation of a security. Can we find beta? Yes. So first task, only help me, the formula would be beta calculation, sir. Beta of a particular stock would be relationship of stock and market into what? Standard deviation of a stock divided by standard deviation of a market. When we have standard deviation of stock and standard deviation of a market, now you calculate, only quickly calculate here all the betas. 1.7, then this is market and this particular stock. One, then point 1 point. Now once you have calculated that, then let's find a KPM equation first. KPM equation would be, sir, RE. KPM RF is how much? 10.1. Leave variable. Market is 4. Minus 10.1 plus beta into 4 point. Now if you get this equation here, now keep putting beta. 1.1 beta if you put, you will get RE. 1.7 beta if you put, you will get RE 17.2. Just keep putting. This is your KPM equation. In KPM equation, you keep substituting beta. 1 beta you substitute, get what? Exactly same as market return. Okay, 0.8, 0.46. 0.56. In 0.71. RP minus RE. You can find alpha. RP minus RE. Alpha. (20 minus 17.24). 0.76. Second is 2 point. Next 4 point. .64 minus this also minus, this is minus point. If you put the ranking now, highest is what? 1, 2, 3, 4 and it has touched your concept of beta, it has touched your concept of the Jensen's alpha both. Let me show. 71. Check the answer one. Done. Now let us practice the comprehension. '87. Number 87. Mr. Abhishek is interested in investing is 2 lakh, for which he is considering the following three alternatives. Invest 2 lakh in mutual fund X, invest 2 lakh in mutual fund Y, invest 120 in X and 18 the Y. Average annual return earned by the mutual fund X and Y are 50, risk-free rate 10, market return is covariance of returns. X, Y and market portfolio mix are as. Understand the meaning of it, please. This call it as grid. The meaning of this is X and X variance. Y and Y is nothing but variance. Mix means market is nothing but variance. X and Y is covariance. X and mix is means basically X, Y, Y market, Y, X, these are covariance. This X and F 4.3 is nothing but covariance. X and with the market is nothing but 3.3 covariance. With himself is nothing but variance. Something is covariance of return given na. With itself will be a variance only. You are required to calculate one by one. Variance of returns from X, F and market. Variance of return. Variance of return is available in the first part only. Variance of returns from variances of X is what? 4.8. This is what? 4.2. This is what? Variance. With itself is what? Variance. No matter how he has done, leave that part according, leave it accordingly, please. Do not do anything. It's simply write 4.8. Second is what? 4.25 and third is what? Alternatively, alternatively, diagonally refer table and identify what the use given by your institute. 4.8, 4.2 and 3.1. First part is done. Very good. Second part. Reading this way. You are required to calculate portfolio return, then portfolio variance, portfolio return. For portfolio return, that means where is the portfolio, sir? Where is the portfolio? Third case. So in this case, if I calculate the weights, let me calculate the weight of X. 1,20,000 by this 60. Weight of Y would be equal to 80,000 divided by 2 lakh. 0.40. And return, how would we calculate? 15% into 0.6. 14% into 0.4. So what is my return of portfolio? How much? Point. That's one part. Now let us calculate beta of each and then portfolio beta. Beta of each, how do we calculate? Of x. Covariance. Covariance stock and market, I'll write divide by variance of market. So for x, if I calculate covariance is x into m 3.370 divide by 3. How much do we get? 1.0087 or 09. Similarly, calculate for y. Covariance, sir, covariance is y with the market 2.8. 2.8 divided by 3.100. 0.903 or 0.90. Now multiply what, sir? 1.087 into 0.6. 0.903 into 0.4. This will give me what? Beta of 1.01. Then portfolio variance. Standard deviation. Portfolio standard deviation and portfolio variance. Standard deviation square of a portfolio will be standard deviation square x, 8 square x plus standard deviation square y plus 2 covariance we can apply na. Covariance xy to what? Of a. Standard deviation square, sir, 4.8 variance into weight square 0.6 square. Y variance is what? 4.250 into weight square. If someone wants to apply, you can apply, please. 4.8 into 0.6 into 0.6. 4.250 is the variance. Standard deviation square is nothing but variance into 0.4 into 0.4 plus 2 into covariance xy. Xy covariance is how much, sir? 4.3. 4.3 xy. No matter which matrix you want to see, both ways it will give you 4.3 into 0.6 into 0.4. You'll get 4.47. And then he said standard deviation of a portfolio 0.1. Let me check the answers now. Weight were 0.6, 0.4, 14.6, 1.087, 0.903. Very good. 1.013 you said na. 4.472, 0.1. Parts done. Third part. Examination question. But 6. You are required to calculate expected return, systematic risk, systematic risk. You have to calculate return of x, return of y is available, return of expected return, that means KPM. Return of x, y portfolio, systematic risk of x, y portfolio, unsystematic risk of x. Okay. Expected return of what, sir? X, y portfolio, x, y portfolio, x, y portfolio. So what will we do? Tell me a KPM. KPM. RF. RF. RF is how much given? Variable leave 12 minus 10 plus. Now substitute the beta of x. Substitute the beta of x and get the answer. 1.087 we got na. Here 1.087 into 2 plus 10. How much do we get? 12.17. Substitute the beta of y. 11 point. Substitute the beta of portfolio. 12.02. This expected return. Second part he asked what? systematic risk. Systematic risk, I'll put beta square of I am putting this security, standard deviation square of market. For X, if I put 1.087 square into variance of market was 0.1, get some number, 3 point. For Y, what was the beta? 0.90 square into 3.10, 2.52, 58, 5285. Then we have to find what? Portfolio. Portfolio beta was 1.013 part 2.10, 3.18. Now comes unsystematic risk. Unsystematic risk is the total risk minus systematic risk. So for X we find total risk of X was 4 point minus systematic risk 1.14. This was what? 4.50 minus 528 or 537. Then you have for portfolio. What was your total risk of portfolio? नहीं total fair form total risk do not become 4.472 minus 3 point, what do you get? 2. This was third part na? Check your answer, are they tallying or not? I don't know. Systematic 1.291, I remember the last one. Becomes the third part. Fourth part now. Fourth part is calculate Sharpe ratio. Sharpe ratio is RP minus RF divided by standard deviation. Treynor ratio RP minus RF divided by beta. Alpha RP minus K-pump return for of X, Y and portfolio mix. I don't know what was examined under the impression was, I not comment on it, but what he was thinking creating this kind of a question. It looks easy when you're doing it here. In exam it's not that easy. Sharpe ratio, quickly find out for all of them. It's actually comprehensive revision which happens. Sharpe ratio would Sharpe ratio equal to RP, return of a portfolio, minus RF. XV, RP is how much? 15 in minus 10 divided by what? 1 point. Now problem is there. You have to do what? You have to calculate standard deviations also. Standard deviation of X and Y. Standard deviation of X and Y. Because you'll have to divide by standard deviation. Na? X standard deviation will be 4.8 under root 2.19. Y would be point. Calculate these ratios. (15 minus 10 divided by this and portfolio etc. Calculate and check, cross check quickly. He has shown directly this way. You'll have to find standard deviation of X, standard deviation. Portfolio standard deviation already had that point. Treynor would be dividing by beta. Beta we know. Alpha we can find. Actual return was 15 and 14. K-pump return we know. Actual return minus the K-pump return, all the alpha. We cross check the part answer. This part I have this fourth part if you want. Done. You can try question number 93 also. Try question number. Mr. Potential has made the investment in two mutual funds. Following information is available. Mutual fund Treynor ratio, I told you, I think starting also is actually 7.14 if you try to put 7.14. Pick up the smart and try for him. 93rd question. Smart, you have a Jensen's alpha. Put down the Jensen's alpha formula. For smart, if I try to put, for example, Jensen's alpha, alpha I know, actual return minus RE. Actual return I know is 8.5. RE I don't know. That means RE should come as 7.4. RE would come as 7.4. RE formula I know is nothing but RF plus beta into MRP. RE I know, RF I don't know, beta I don't know, and risk premium 4% is given common. Using this, now try to do some equation form from your side and calculate what best you can do. Using Jensen's alpha, I calculate RE number. Using that RE and RF plus beta into MRP, we arrive at some conclusive part here. Means RF and beta are unavailable to me now. Now I can use Treynor ratio in certain way. Treynor ratio formula is what? Treynor ratio is return minus the RF divided by beta. The problem is actually I have two variables here, RF and beta. So to solve this problem, what I do is I use a Treynor ratio. So Treynor ratio is RP minus RF by beta, this 7.14 RF. So what I can substitute is value here is basically 7.14, 8.5 minus RF. So instead of beta, I take value of a beta from here, substitute here. This will help me in solving the. Basically from here I can put the beta. Beta is nothing but from here, beta is equal to, if you look at beta is equal to 7.4 minus RF divided by 4. And the moment I get this equation from the Treynor ratio, in this I can substitute beta. The moment I substitute beta, everything would be in the RF form. And then when I solve this equation, get some answer. 7.14, 8.5 minus RF divided by 7.14 minus RF by 4. RF should come as around, try to check, RF come as around 6%. And then you can put the RF in the beta equation. Done. Then similar exercise apply for the growth, second part also. In that you will have a slightly reduced work because RF you know now. SML is nothing but that equation. Jensen's alpha he can touch this way. Treynor ratio, Jensen's alpha, touch in different forms. Done. Small exercise 90. This 36 is a commonly repeated question. You can try as a home. I have given you the answer. Try 36. 36. Try as a portfolio rebalance, variance, cover up rest of the. Take care. One question you can try as a homework. 30. Yeah, bye.